Welcome to our Taking Stock video for the week ending the 31st of May 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst, Daniel Ortisi, to stream to you all things share markets. How are you today, Dan?
Yeah, good, Ken. Good to be back for another episode.
Yeah, great to have you on board, Dan. But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Well, Dan, it's been a very interesting week on the markets. The Australian market specifically has lost some steam following a hotter than expected inflation print. And this has prompted traders to bid up bond yields and also ditch equities with this rising risk that the RBA may need to lift interest rates to push inflation down. The recent inflation data does suggest that the consumer price index rose to 3.6% in April from about 3.5% in March. So it's moving up and it remains well above the RBA's target inflation rate of between 2 to 3%.
Yeah, spot on, Ken. And in addition to that, with tax cuts on the horizon, there is rising concerns that inflation will remain elevated for some time, sparking fears that interest rates will obviously remain higher for longer. In fact, amongst the developed nations, Australia's inflation rate has actually been the most sticky. The bond market is now implying only a 20% chance that interest rates will be cut in March, which was fully priced in earlier on in the month.
Yeah, with sticky inflation, we certainly are a lucky country there, Dan. But the higher for longer inflation and also interest rate environment is certainly having an impact on ASX stocks. We've seen earnings downgrades start to accelerate over the last month, specifically across those consumer-led sectors. You know, we've got the retailers, for instance, Reject Shop, Bapcor, Eagers Automotive, even Kogan, for instance. Building construction are all quite vulnerable at this stage. You know, Fletcher Building, James Hardie released results below expectations. Telecoms, Telstra, Spark New Zealand, and even some healthcare stocks like pathology company Sonic Healthcare as well, also downgrading. Meanwhile, the areas of the market that appears to be most resilient over the last month include technology, banks, transportation, and some REITs as well.
And focusing more on the resources space, Ken, it does appear to be quite a mixed picture. Downgrades have occurred across energy, although there were positive revisions emerging from stocks with exposure to base metals like nickel, copper, and aluminium, courtesy of course, higher commodity prices. And within the resources space, mining giant BHP Group has abandoned its bid for Anglo American due to the complexity of the proposed structure, which of course has been a large news event for the last couple of weeks. In the end, Anglo was not prepared to spin off its South African platinum and iron ore business before selling itself to BHP. The reason for that is because they believe the South African government would take advantage of the situation, it potentially enacting things such as forcing more job hires, higher capital spending, and black empowerment conditions, which would be detrimental to shareholder value.
Yeah, that's very interesting, Dan. But for BHP shareholders, though, the unsuccessful takeover, what that means is that BHP will not be able to expand its exposure to copper, which is crucial to the energy transition and artificial intelligence boom. But this news does suggest that the management does have strong discipline in pricing these deals and will not pursue growth at all costs. But let's now move on to some star stock highlights for the week. We had borderline star growth stock and electrical distributor IPD Group. They released their earnings guidance, which was well ahead of expectations, Dan. But this has led to upward earnings revisions on the stock of around 5%. But Charlie did highlight that the upgrade is due to inorganic acquisitions from their recent takeovers of Adelec and also Gemtech businesses.
Yeah, that's right, Ken. And Charlie does remain satisfied with IPG's placement in the borderline star growth category. So not looking to upgrade to star growth off the back of this update, even though the guidance appears to be good news, of course, on initial expectations. But of our focus is the integration is not leading to organic growth in the underlying business. Funnily enough, we did notice that the stock price, appeared attractive, trading at a 20% discount to fair value, although investors should be mindful that consensus coverage range is very limited with this stock, with only around 4 consensus analysts covering the business.
Yeah, we've got to be careful with the outlook there as well, Dan. But turning our attention to an emerging opportunity that has hit headlines after the company released positive trial results is biotechnology company Neuren Pharmaceuticals. The financial metrics on Stock Doctor, they do look exceptional, Dan, with return on equity at around 127% and also margins at 67%.
Yeah, it's definitely one we've had a bit of a chat about in the team for quite a few weeks now, Kien. And for a bit of background, the company has a drug in commercial use called Daybue, which is a treatment for a rare disease known as Rett syndrome. The product is sold through a distribution partner in the United States, a large biotech company known as Arcadia, who then pay Neuren a royalty on fee on sales. So the treatment at this point in time is only approved in the US. Neuren was paid a lump sum fee of around 145 million for the first sale milestones in FY23. And that obviously is what is driving these really large return on equity and net profit margins. And earnings per share growth is obviously looking astronomical in that period, Kian.
Yeah, it's important that we look deeper into those numbers, Dan. And moving forward, Neuren will primarily receive royalties, which is why analysts are projecting declining margins and also return on equity for the year ahead. But as with all biotechs, though, especially in those early stages of their life cycle, there is an element of risk with the success or failure of these clinical trials. Positively, though, over the week, Neuren did announce successful trial results for its proposed treatment of Pitt-Hopkins syndrome, which could translate to stronger earnings in the future.
Yeah, that's a great point, Ken. Investors should be mindful that Neuren was subject as well to a short report earlier on a few months ago by Culper Research, who suggested that Arcadia has misrepresented the drug safety and patient retention rate. The level of short interest has begun to rise modestly since the start of the year, and investors should continue to pay attention to this metric. But with $240 million in cash at the moment, we do believe that the level of insolvency risk, so from a financial health perspective, in this business remains very low.
This place is quite exciting, Dan. And for those looking at other opportunities, especially in biotechs, another one to keep an eye on is cancer diagnostic radiotherapy group, Telix Pharmaceuticals, which has recently turned profitable and has one period of strong financial health. Now, the forecast growth numbers do look quite strong here, and it appears to be well covered with 8 analysts on the radar. But you can find this in Tim's growth filters with potential and many other stock opportunities here as well. In Under the Microscope this week, we take a look at payroll and accounting software business and newly elected star growth stock, Xero. On Stock Doctor, you can see that return on equity has a significant uplift over the year to 15%, and net profit margins are now close to 10%. Well, earnings have been driven by subscriber growth, price increases, and also the shifting customers towards those premium tier plans. So compared to other accounting software providers, Dan, what is their competitive advantage?
Yeah, all very good points, Kian. And our belief is that Xero is one of the world's leading accounting software providers with a strong competitive edge to its product differentiation and, of course, due to its size, the scale of economies here. Within our channel checks, we have determined that Xero's product remains well regarded, and its holistic coverage of tax, payroll, and payment solutions means that Xero's clients receive a one-in-all bundled solution and the ability to integrate into other software packages.
Yeah, aside from the product side as well, the company's dominant market share in Australia and New Zealand does allow the company to outspend local competitors. Yeah, and their competitors are MYOB and also Recon as well. So they spend in R&D and also product development, which we believe represents a sustainable long-term advantage for the company.
That's right, Ken, and that obviously could be a reason why we're starting to see a big increase in net profit margins because of that competitive advantage in R&D spend. And it looks like growth is expected to continue. We can see that a return on equity is approaching towards 18% in the forecast periods, and that would be given its high penetration in Australia and New Zealand. However, of course, Xero's growth is reaching a ceiling in their core markets, and now management are targeting, overseas markets such as the US and obviously they're small and medium enterprise businesses.
Yeah, it's always challenging also to penetrate other markets, especially in the US. But with the recent leadership changes, especially under new CEO Sukhinder Cassidy, we believe Xero's ability to penetrate the US market has improved, despite you have the dominance position of incumbent technology companies like Intuit with their smaller, but in our view, less intuitive and accounting focused product called QuickBooks.
And note that due to the recent appointment of the CEO, Sukhinder Cassidy, Kien, there is no salary information available on Stock Doctor as of yet. But she, of course, is well known and well regarded, and having embarked on a restructuring program that has led to cost cuts and the divestment of non-core businesses such as Waddle.
Yeah, definitely. The focus for her now is changing the business dynamics to be more efficient as opposed to pursuing growth at all costs. And this is yielding dividends. And the stock does trade at a modest discount to fair value, despite the share price rising strongly on the back of recent results. Although potential investors should be mindful that the stock like this in the early growth phase can trade on high PE multiples, currently at about 60 times forward, 26 times PEs. However, this will rapidly come down if the earnings growth expectations are met.
And focusing on the risks, Kien, we think that the most prevalent active risk at this point in time is the execution of the overseas expansion. And of course, when looking to expand overseas, we can expect rising costs and investments to facilitate this growth. Now, this may have a short-term effect on profits, and this could obviously be greater than investors think at this point in time, hence which is why we think it's one of the most important risks to focus on.
Now, under Golden Rule 3, and let's use Xero as an example here, we can see that earnings forecasts are up by about 16% over the last 3 months. So a useful question for investors this week is, why are earnings revisions an important factor when assessing stocks?
Yeah, great question, Kien. Brokers and research houses typically have analysts who cover listed companies and provide an estimate on a company's future earnings. Earnings revisions, therefore, is a momentum factor that measures the change in the median of these consensus forecast earnings over time. Changes to earnings estimates reflect changes to the company's future performance, mostly driven by an unexpected trading update or earnings result. Our research has indicated that a strategy of selecting stocks with the highest earnings revisions or avoiding those with the worst earnings revisions over 3 months can generate above market risk-adjusted returns.
Yeah, very interesting, Dan. And as you can see from the chart on screen, if we construct a portfolio with stocks that have the highest ranked earnings revisions and rebalance the portfolio every month, and that's shown in purple, the performance of this portfolio significantly outperforms the broader market, and that's highlighted in blue. In the chart, we've also shown a portfolio of only financially healthy businesses in green. And as you can see, financially healthy stocks tends to add value above the broader market over the longer term.
And we have included 3-month earnings revisions under Golden Rule 3 to help members make more informed decisions when selecting stocks for their portfolio. You can also visualize the earnings trend under Golden Rule 4 by selecting EPS forecasts 12-month in the drop-down menu at the top. This allows you to identify opportunities, especially if the earnings trend is rising and the share price has fallen.
Yeah, we're certainly seeing that disconnect also in the broader market as well, with the overall trend in earnings down while the markets continue to trade close to highs. But note also that the earnings revisions fields can also be found in the stock filters, the watch lists, and even the alerts. And it's called consensus EPS estimates change under the alerts functionality. Well, Dan, that's all we have time for today. Thanks for your insights once again.
It was great to be on, Ken. And of course, if we have any further questions, then members, please feel free to come along to our Lincoln Live webinar that's hosted on Mondays.
And also, it's great to see that we've had very strong interest with our Stock Doctor Platinum service. So if you're interested, please let us know as well. For now, take care and have a happy, healthy, and prosperous week ahead.